Let's, actually carry on this conversation, understand more about the impact that actually comes in and the initial assessment that is going to have in terms of the impact. We're joined by Mr. Kartik Srinivasan, Senior Vice President and Group Head of Financial Sector Ratings at ICRA. Thank you so much, sir, for joining in with us. Let's just start by understanding what is it that you understand, or, if you could give us an understanding in terms of the initial assessment and the impact that one should be expecting here on banks as well as NBFCs.
Thanks for calling. One of the things that we need to look at it is the RBI's directive yesterday increases the capital allocations which banks and NBFCs need to do for consumer loans. Now the impacts would be different across different players and different type of lenders. If you were to look at banks, for example, banks have a very well diversified portfolio. Their overall exposure to consumer loans and NBFCs non-PSL kind of loans would be relatively on the lower side in terms of percentages, maybe 10, 15% or maybe 20% at most. So for the larger NBFCs which have again a well diversified portfolio, the impact could be lower. Specialized entities looking only at consumer loans or only at certain type of asset classes, the impact could be higher. Our initial assessment at this point in time is, let's say if we were to look at something like a bank or a well-diversified NBFC, the overall impact on capital may not be material. We're still reworking on the numbers, but initial assessment does seem to suggest that the overall impact on the current capital would not be more than 75-80 basis point as such. But for entities which are specifically focused only on these segments, the impact could be higher. Having said that, almost all NBFCs and banks are sitting pretty comfortable on a regulatory capital adequacy at this point in time. So it's not really going to be a concern from that point of view. The concern does come in the sense that one, the growth rate which has been fairly robust over the last year and a half, that definitely would see some kind of a slowdown, given the increase in capital, and banks and NBFCs have also been advised to recalibrate and have exposure limits and border level policies around consumer lending. So from that perspective, RBI has been voicing its concern that the growth, both in terms of bank lending to NBFCs as well as banks and NBFCs lending to the consumer segment, has been growing at a pretty fast clip over the last 2 years. And more so on a precautionary measure is what I feel. RBI has come out with this measure to sort of slow down the pace and then maintain the financial stability or sanctity in the system.
Okay, very well said that private banks and NBFCs are well capitalized, so they won't need fund. But when it comes to PSU banks, what we are seeing here is that the CET ratio is on the lower side. In fact, for SBI, it's below 10%. And post this regulations, this would further come down. So which PSU banks would require the funds or will have to raise funds at earliest as per you?
It's difficult to comment on bank specific or entity specific at this stage, because the circular also has a lot of caveats in terms of exposures towards PSL are excluded and all those things. So we really don't have those granular numbers at this point in time to comment. But yes, at a broader level, entities which are low on their CET levels would need to shore up capital, or they need to sort of slow down on their growth expectations over the near term. So in any case, we need to probably wait and watch how banks and NBFCs react to this. We maintain our stance that at least on an immediate basis, there's not going to be a significant capital pressure on any of the entities, that it should be manageable. If the question comes in case their own growth expectations are significantly higher than the internal accruals that they are reporting at the current instance.
Any initial assessment that you have done on the cost of funds side, by how much could the cost of funds increase for NBFCs and for banks as well?
It's early days to quantify the impact. Again, one needs to look at it with a different lens as well. With the new RBI guidelines on investment norms and moving portfolio to HTM, that regulation kicks in from 1st of April. Banks have more flexibility to park funds in HTM even on corporate bonds. So it'll be one needs to see how that really plays out. But we clearly see that there would be pricing pressure. Cost would definitely go up for NBFCs and possibly to the underlying borrowers. If that doesn't happen, then the NBFCs would possibly see a dip in their interest margins. But very early to comment on what sort of impact would you really see on the cost of funds, especially at a portfolio level. There would definitely be some knee-jerk reaction. You could see some immediate hike in the incremental borrowing rates. But if one was to look at it at a portfolio level, the impact would be visible only over a period of time.
I also just want to know what would be the impact of this on fintech companies also, how does that come into play, something like a Paytm, if you could explain us that.
See, for fintech companies in general, they do have a lot of tie-ups with banks and NBFCs. So now depending on how the banks and NBFCs re-strategize their business model towards consumer lending, that would have a play in terms of how the impact would fall out on the fintech companies. Which again is really very difficult to quantify. I wouldn't want to hazard a guess at this stage. But clearly that's a segment. The fintech and the consumer lending is a segment where RBI has been voicing its apprehensions for last couple of quarters, and the measure is clearly towards curbing excessive growth on those segments.
Right, sir. Thank you so much for joining in with us this afternoon on ET Now, as well as, talking to us about the impact that could come in on the banks as well as NBFCs of the new regulation that has come in from RBI in terms of the norms for these companies. But let's move on. And, Nifty Bank as of now not doing anything exciting, down 1%. It continues to be at those levels, negative trajectory trading on that front. But let's step into a very short break. Don't go anywhere. We'll be back with more updates after the break.